All right, we're going to look at the debit credit theory, and we're going to look at it a little bit differently today for any of you that are still maybe having a little bit of trouble with it. What I want you to look at is on the debit side, think about this is how we use our money. All right, so this is how we purchase assets. This is how we, purchase and we look at our expenses. This is really how we are getting things. This is our uses of our stuff. It is really, if we look at cash, that's a savings. That's how we're using our money also. If we look at the credit side is our resources. So when we look at this, how are we getting the things that we need? So we could be getting them through a loan. So if we're getting a loan, we're borrowing that money. That could be how we get some things. With the capital, we could be getting things through the owner. So the owner could be investing in the company, and so that could be a way that we actually get money and get other assets and pay our bills. And then another way is that revenue. If we're not making money, then we cannot generally purchase things, and we can't have our uses. So I want you to think about it as on the debit side, this is how we are using, and on the credit side, this is how we these are our resources and how we're able to get the money that we need. The first thing I want to look at here is I want to treat this as a balance and treat it as like buckets that we put things in. So if we look at the owner investing $10,000, well, we can put that $10,000 in that asset bucket. So this is the cash and this is our asset bucket. And that is going to weigh that debit side down because we have something in the debit side, but we don't have anything on the credit side yet. So if you put and only do 1/2 of an entry, then you're not in balance. So what we will do next is the other side of that entry is going to be the capital account as a credit, because that's where our resource is coming from, is from the owner. And so once we put the money into the capital account, what happens, if you think about it, we had a scale here, okay? So if we have this scale that we're looking at and we have money here, what happens when we put the money over here also is that the scale is no longer going to be out of balance. What's going to happen is that now when I put money on the other side, it actually balances out the scale. And so that is what we're looking at, is we're actually looking at how we balance everything out. Another entry we can look at is purchasing supplies. So when we purchase supplies, our cash is going down. So when our cash goes down, what we're looking at is, this scale, the credit side is heavier. So we have this going on where the credit side's heavier because we've taken money out of the pot. And so when we look at the other side, our supplies, which is also an asset, is going to increase. So we have it coming back into balance, to where it's not out of balance anymore, because now we are equal. And so we're in balance. Now there are different ways that we can be in balance. And we could, in theory, what this is looking at is that we will have a plus and a minus on our debit side. So we could increase asset and decrease another asset. We could increase an expense and decrease an asset. We could increase the drawing account and decrease an asset. Those are some of the things that we could do on the one side. It would all be on this debit side. So transactions can happen and all be on that, what we call the normal balance, or that debit, that uses, I guess I should say, instead of debit side, that's all on the uses side of the scale. The other thing that we can have is we could have a plus on the uses side and a plus on the resources side. These would pretty much, an example could be where we increase an asset or an expense. And then on the other side, we could increase a liability, a capital account, or a revenue. An example of this was that first example we did where we looked at cash and capital. We're increasing a use side and we're increasing the resource side. Another thing we could have is where we've decreased the use side and we decreased the resources side. These would actually look at decreasing on both sides. An example of this is when we actually would pay a liability. We would decrease our cash account and we would also decrease that resource side in the accounts payable because we no longer owe that accounts payable. Another situation that you could have is you could have an increase and a decrease over on that resources side. What you have to remember with all of this is that your scale has to stay in balance. So I want you to think and just remember that when you are looking at this T account, you can also look at it as a scale. Look at it as if you put something on one side, you either have to put something on the other side or you have to take something off of that side because it has to stay in balance. So, and the other thing, if you only record one side of an entry, your scale is going to be off. So you need to make sure that you are recording both sides of your entries because we want our scale to be in balance. So again, thing to remember is, this side, the debit side, is how we are using things. The resource side is going to be your credit side. So this is how we are getting those resources. Again, think of these as buckets, all right? So we have a bucket with our assets, a bucket for the drawing, bucket for expenses. We will have a bucket for liabilities, a bucket for the capital, and a bucket for our revenue account. So if you put something on this side, your scale is going to look like this. It's going to be off balance. So we probably need to make sure with everything that we do that our scales are in balance because ultimately our debits have to equal our credits.